Hey, Kyle Wingfield here, back with you with another set of questions that I should be asked, but I never am. And the question is this: how much of my money is going to hit my tax return when I retire? Think about that. Think about the majority of accounts that are used to save for retirement, right? What are they called? IRAs, 401ks, 403bs, TSPs. But what are they really considered? They're considered qualified plans which defer the tax, okay? So that means when that money comes out of those accounts in retirement, if you want to spend it, it will be fully taxed at ordinary income. So you're thinking to yourself, Kyle, why is that a big deal? I'm going to tell you why it's a big deal. Because as that money hits your tax return, right? Once it hits the tax return, guess who wants a cut? Uncle Sam. Now, the more money that hits your tax return potentially means the more you could pay in taxes and the less you'll have to spend. So what I'm going to do is break this down in two parts. I'm going to switch over to my computer screen so I can prove it to you. I can prove to you why having money hit your tax return could potentially mean paying more in taxes. Okay? So let's go take a look at that. I'm going to run you through an example pretty quickly that it's easy to follow so that you can see that why this is a question that should be asked, but it never is. Why is understanding or asking the question, how much of my money is going to hit my tax return? Why is it a big deal? Okay? So let's take a look. Okay, here we are at my computer screen where we're going to take some time to really prove and validate the question that should be asked that never is, which is how much of my retirement income is going to hit my tax return. So how much of my income is going to hit my tax return when I'm in retirement, and why does that matter? So whenever we talk about tax returns, we always have to get into a conversation about income tax rates, or at least the future ones. And the three questions that are out there for everybody right now that you might be pondering or you've pondered prior to listening to this and watching this: will future income tax rates go down? Will they stay the same in the future? Will they go up in the future? I don't know. Who knows? Who's in control of that? Not us, right? It's the government. So here's the thing. I'm going to show you an example of what if future income tax rates just stayed where they are. What if your income tax rate just stayed where it is once you get into retirement? And here's the next question. How will a change in future income tax rates affect your retirement? How will a change affect you? So let's build a picture. Who will win the race? I always like to call it, it's kind of like a horse race of sorts. But when it comes to taxes, when it comes to saving money and tax diversification, there's really kind of three tax classifications that you can put your money in. You can either have a tax deferred account, which is the most popular, most common account which people use to fund retirements. We know that as 401ks and IRAs. Then there's the taxable, which I like to refer to as Tax Me Now or Tax Me As I Go. That's like buying a CD or investing money in a CD with after-tax dollars. And then you've got your tax advantaged or your Tax Me Never or Tax Me Free account. Very familiar, very commonplace. It's like a Roth account. So tax deferred, which I call Tax Me Later. What's another word for defer? Delay or later. Tax Me As I Go or Tax Me Now, which is a taxable investment. Tax advantaged or a tax-free or Tax Me Never account as the money grows in that account is something we're all familiar with called a Roth. So we're going to look at the three tax classifications here and what happens. So let's build a picture. We're going to save $15,000 a year for 20 years. We're going to assume a 6% rate of return, a 33% tax bracket. And what we want to do is after we save for 20 years, we want to start pulling income out of this account for 20 years at the tune of $23,333.45 and see which account makes it. Okay. Now remember, taxes are going to stay the same. Our tax bracket's 33%. All right. Save for 20 years, 6% rate of return, 33% tax bracket. And the net income we're trying to achieve at the 20-year mark to spend for another 20 will be 23 grand. In the Tax Me Later account, we can put $15,000 to work because that money comes right off the top, right? $15,000. We defer that tax. We don't wait. We're going to wait and push off the servicing of that tax to a later date. So we're going to put $15,000 to work for 20 years in our Tax Me Later account known as your IRA or your 401k. Now we're going to take
$15,000, we're going to put it in the Tax Me Now account. When you fund accounts like that, you got to pay your taxes up front. So what we really get to put to work is right here, this $10,000, right? Because that's really $15,000 net after tax at 33%. So we get $10,000 to work for 20 years. And the Tax Me Never account, the tax advantage account, like let's say a Roth, you're putting that $15,000 to work, but what do we do with the 15? We pay a third in taxes up front today. Therefore, we get $10,000 to work for us, and any gains in that account are not subject to tax. Okay, what happens? 20 years later, your tax deferred account, your Tax Me Later account has $389,000 and some change in it. Your Tax Me As I Go or Tax Me Now account's got $309,000 and some change. And your tax advantaged, or like your Roth account, it's got about $389,000 and some change. Okay, so that's the accumulation period. Now we're going to transition into the spending phase. So we accumulate it for 20 years. Now we're going to spend for 20 years. Let's take a look and see how that works out. Here we are, Tax Me Later. Now, what's unique about this, tax brackets staying the same now, 33%. There's our assumed rate of return of 6%. And we want a net income of $23,000 right here. So what we want to do is, or what we have to do, is we've got to pull $35,000 out of the tax deferred account. Why? Because we have to service the tax on that money because we've been putting it off, we've been delaying it. So we got to pull $35,000 to net $23,000. Right? Out of the Tax Me As I Go account, we've already paid taxes not only up front with the money to fund it, but as we went along, so to net $23,000, all we have to do is pull $23,000 out and some change. Then on the Tax Me Never account, we paid the taxes up front. Any of the gains, anytime we take in distributions from this account and spending the money, we're not subject to tax. So we only have to pull $23,000 to net $23,000. So let's find out who has the bigger balance at the end of the 20 years of spending. There's $340,000 in the tax deferred account, the Tax Me Later account, the 401k. There's $74,000 left in the Tax Me As I Go or the Tax Me Now account. And there's $340,000 left in your tax advantage or your tax-free account, the Tax Me Never account. So if you're looking at the screen right now, you're going to notice that the tax deferred account or the Tax Me Later account has the same balance as the Tax Me Never account. But are they truly the same? Remember the question. How much of your income in retirement is going to hit your tax return? Although on paper these appear to be the same, are they? Money beliefs versus money realities. What's the reality? We all believe them to be the same. Numerically, mathematically, it works out to be the same. Right there, boom, there's the math. But what's the reality? The money from the Tax Me Later account has to do what? It has to hit your tax return. Anytime money touches your tax return, it means you got to give some to the government, right? Which means you have less to spend potentially. Okay, so let's take a look. Now follow me here. I know it can be kind of, when you see a screen like this, for many people, they look at all these, oh my gosh, what is that? Hang with me here. This is a digitized tax return. So what I want to demonstrate is money hitting the tax return and the tax effect to the money for the person who's putting the money and taking distributions from the tax deferred account versus a person who doesn't have money in the tax deferred account and they're taking the distributions from a tax advantaged account. All right, so here we go. We've got $35,000 coming out of his IRA and annuities and things like that. We've got $40,000 coming from an annuity and pension. And we've got a $30,000 Social Security benefit. So, what happens? Up to 85% of that person's Social Security is being taxed. So that's about $25,500 of Social Security is being taxed. So what would happen if we could get our we didn't take the distribution of $35,000 from a taxable account, but instead got that net number, which is $23,000 from a tax advantage account. What that would mean is we wouldn't have to report the 35 grand hitting the tax return. So what happens is this: by not having to report $35,000 hitting the tax return, because we can get that net income of 23 grand from a tax advantaged account, let's say like a Roth, we're able to pay $10,000 less in Social Security being taxed. So $10,000 less of this person's Social Security is being taxed. So what does it look like? Well, we still need the 23 grand net income to enjoy our lifestyle. It's just about where's the money coming from? Where did you park it and where is it coming from? Which denotes whether or not it hits the tax return, which then means, are you paying more taxes? What does it look like? Person A, who had their money come from a tax deferred account, all that money's hitting the tax return, so they got to report $78,700. The person who understood using a tax advantaged account and understood the power of, or the question of how much of my income is going to hit my tax return in retirement, they made sure that a limited amount of money hit that income tax return. So now they report $33,550. Both people have the same net spendable dollar, because we still have our $23,000 coming out right here, but it's coming from a tax-free source. So what does it look like in taxes? Person A is paying $11,735 in federal income tax. Person B is paying $4,163 in federal income tax. That's about a $7,600 difference. That's the wealth transfer. That's the power behind how much of your money is going to hit your tax return. That's the power behind asking that question and then starting to backtrack and say, okay, where am I parking this money right now? And what's going to be the impact when I start taking that money out in respect to taxes, in terms of how much is hitting the tax return? What if tax rates are higher? What if tax rates are lower? Hey, it really doesn't matter how much is hitting the tax return, because here's what we got. You could either pay $11,735 in this example of federal income tax, or $4,163. The difference between the two is one person understood or asked that question. The other one didn't know to ask it. All right, just phone call away. No pressure, no obligation. Here to help make your tomorrow better than your today. Talk to you soon.